Y nosotros nos trasladamos ya para hablar de más macroeconomía, de bolsa, de mercados, y lo hacemos de la mano de nuestro invitado internacional, Mounier, jefe de desarrollo de negocios de renta fija en AllianceBernstein. How are you, Arnaud? Thank you for coming.
Thanks for having me.
Well, first of all, talking about the US debt ceiling and negotiations between Democrats and Republicans seems to be stalling. What is your view on AllianceBernstein about the potential US default? How should we position ourselves?
Well, thank you. It's certainly the US debt ceiling issue is not a new one. If we put things into a context, the last time we had this issue very prominently was in 2011, when we had a lot of stress in the market because of this debt ceiling issue, and then at the last minute, Republican members agreed to increasing the debt ceiling in exchange for spending cuts. And again, putting things into context, if we think about as early as 1960, I mean, for the last 60 years, we had about 75 times the debt ceiling issue. So it's not something new. The market knows that it can happen. But what's more difficult this time is that the politics in the US are so polarized that any agreement will take a lot of time. And so it's very likely that any agreement will happen at the last minute. So our own view is that a default is still going to be avoided, either by agreeing to increase the debt ceiling or by kicking the can down the road and giving time, a few months, to discuss further any political agreement. So in terms of positioning from a market point of view and from a portfolio point of view, we have not really changed our portfolio's positioning in view of this debt ceiling issue. But we were already positioned for a more prudent, I would say, risk-off environment. So we have not really changed that, but we just want to be prudent at this juncture in our portfolio construction. If one thing, we do not own any T-bills that are going to mature in June, and that may be in this technical default situation. Now, if we see a tail event, the default that could happen in the market, if this default situation was to last longer than expected, there would be a risk of downgrade of the US debt rating, and that would trigger a further risk of sentiment in the market, which would quite counterintuitively lead potentially to the US Treasuries to rally as people are looking for safe havens. So again, it's not a base case scenario, but that could happen in a tail event.
I was asking you about the stress in the US regional banks.
Yeah.
They talk also a lot during March, the commercial real estate. Do you think it's a concern, or do you see that as an investment opportunity?
Right. Well, if we look at the recent research about US regional banks, basically they own 70%, give or take, of the commercial real estate loans in the US. So obviously when you have such a stress in US regional banks on their deposit base, that's going to have a spillover effect on commercial real estate market. And the real issue for the commercial real estate market is not only the tightening of the lending standard by those US regional banks, but also the fact that interest rates are much higher, and the fact that we are also expecting the value of these commercial properties to go down as investors are looking for higher yields when they invest in this type of property. So there is definitely significant scrutiny by investors about the commercial real estate market. Now, for us, it's very important to differentiate what type of commercial properties we are talking about. So if we are talking about offices, if we are talking about retail malls, there is certainly a lot of stress there, especially post-COVID, the behavior of consumers, the behavior of workers going less into offices and working more from home is definitely impacting these sectors. If we are now talking about properties like lodging, multifamily, industrial properties that are very much in favor because we have all these online technology developments, and so you need to store I would say, all these data centers into these industrial properties, they are actually doing pretty well. So overall, we are trying to differentiate between the sectors. We are also differentiating between vintages of loans to see opportunities in that area of commercial real estate. So my message for your viewers is certainly that there is stress in commercial real estate, but that will also bring opportunities for some investments.
Thank you, Arnaud. And also talking about central banks, we are seeing, like in the US, the Fed could get closer to a pause. In Europe, maybe there's still some rate hikes on the horizon. But with this game plan, how do you manage interest risks? How do you manage the duration of the portfolios?
Yeah, sure. So I think it's a pretty consensual view now that the Fed is likely to pause. Probably in June, maybe a bit later. And so I think this is quite well understood by the market, and we would agree with that. Now, where we disagree with a lot of market participants is we don't think that the Fed is going to cut rates in 2023. When you look at what the market is pricing, is they're thinking there could be some rate cuts as early as October this year. But we think that if there are some rate cuts, it's more likely to be in 2024. And the reason for that is that inflation is still a long way from being at target of 2%. And so the Fed is going to look if we are making good, steady progress on inflation going down. For us, the view that inflation by the end of 2023 will be at 3.5% in the US means that things are progressing in the right direction, but the Fed has no, I would say, hurry to cut rates, in our opinion. So what does it mean is that interest rates could remain volatile as the market needs to adjust to this potential reality. Now, when we think about our duration game plan, when we think about growth slowing down, when we think about inflation normalizing, what does it tell us is that interest rates, the 10-year yield in the US, is more likely to go down from this current level in 2024. So more likely that after the summer, we will increase our duration as we are going to position our portfolios for interest rates to eventually go down next year. When we think about Europe, as you said, ECB is still likely to increase rates a bit longer than the Fed, mainly because they started later than the Fed, and inflation is still quite sticky, especially for services. So here, the game plan for us is maybe not to extend duration too quickly now in Europe, but again, as we get toward the end of this year, as again, we are seeing some progress on inflation, and we are seeing growth slowing down in Europe as well, then we want to increase duration gradually, probably in Q4 this year, as we forecast interest rates to be lower as well in Europe next year.
Thank you, Arnaud. And finally, I want also to ask you about Europe also, about the credit market, because since the Credit Suisse collapse, it seems like the situation has stabilized during the last months. And do you think there's some opportunities or there's still some risk ahead for this credit market?
I think it's a fair observation that the market seems to have digested the Credit Suisse stress, especially the banking sector. So overall, we are quite comfortable with European credit, investment grade. We still like the banking sector, more on the senior part of the capital structure of those banks, even though on a few select bank names, like especially the national champion, we are still okay to own some of these subordinated bonds that have went through a lot of stress in March. But we think that, again, given the valuation, that can be quite attractive. What we like as well in European credit is covered bonds. That tends to be bonds with a very strong credit quality, but paying a nice premium over government bond yields. So that's an area where we've been overweight for a few weeks now. And finally, I would talk a bit about European high yield, because obviously people are concerned about the recession risk, or at least slowing growth that could increase default risk in the high yield space. So to that extent, we are being quite conservative in our positioning in high yield, meaning that we reduce our exposure to the lower rating, like triple Cs. We also shorten the maturity of the bonds we are purchasing, focusing on the 2 to 3 year part of the market. And then we are going to go for industries that are less cyclical in nature. But I think it's important to say that even though we are being more conservative in our high yield allocation, we still think that European high yield has a part to play in a European fixed income portfolio. So it's not to say that we would go to a 0% allocation in European high yield. We still think there is room for an allocation to European high yield when you can get 8% return on this type of investments.
So thank you very much, Arnaud, for answering all our questions. Arnaud Mounier, jefe de desarrollo de negocios de renta fija en AllianceBernstein. Thank you for your time and for your analysis.